Malaysian economy, as I said, has announced through 2 stimulus packages something like 9% of Malaysian GDP in terms of a boost through government spending and tax cuts. China, as we know, something like 6% of GDP has been spent or will be spent by the government to boost growth. And you could argue that the Chinese decision to move quickly and move early was a really important driver in the first signs of recovery that we saw back towards the end of last year and into the start of this year. So what were the objectives of policy, and have they worked? Well, the first objective, I would argue, was just to bring about some degree of financial stability back to the global economy, providing banks and individuals with access to liquidity again so they could fund themselves and finance themselves on an ongoing basis, helping banks work out the distressed assets that they held, providing support, in some cases through direct investment from governments, to provide support for weak financial institutions to strengthen balance sheets, also to provide support for the private sector in the form of subsidies on mortgages and delays in repayment of mortgages for individuals, and finally regulatory and supervisory reforms in order to bring about a more stable financial system. I think we can say so far policy is working, but with a few caveats. Policy is working as proxied by the difference in interest rates that banks charge to lend and borrow from each other versus the interest rate that the central banks charge banks to borrow. That rate is now back down to what we call more normal levels and reflects, I think, improvements in the liquidity of the financial system. Credit risk, or the risk of default as proxied by spreads over risk-free assets in both emerging market bonds and high-yield bonds, have fallen significantly, as we've seen. And I think there's a real and genuine fundamental reason why that should have happened, to reflect an ongoing improvement in financial conditions. But there's still a long way to go. The IMF also estimates that by the end of this crisis, banks globally, in particular those banks in Europe, the US and the UK, will write off something like $2.3 trillion of bad debt. And only about half of that $2.3 trillion has been worked through so far. So there is still a very large debt overhang that banks in Western Hemisphere markets must work through before we can genuinely say that they are back in good health. Clearly, the other objective of policy was to bring about a recovery in economic activity. And so far, as with the fiscal policy side and as with the financial stability side, it looks like policy is working. When we look at indicators that try and provide us with a guide to growth over the coming 6 to 12 months, in China, in Malaysia, in the US, they're all telling us that growth not only has recovered, is likely to continue recovering over that time horizon. Fiscal policy, monetary policy, and what we call the inventory rebuilding cycle, where businesses allowed their stocks of goods to be run down as demand fell, have now started to rebuild those inventories again in anticipation of a better growth environment. And that's been an important boost to growth around the world. A growth recovery that has been largely led by Asia, a growth recovery that has begun and is now gaining momentum in Europe and in the US. But arguably in Europe and in the US, we see signs and reasons to think about that growth recovery moderating to a degree as we move through into 2010. And we really believe that a sustained recovery beyond what we've just seen in the last 6 to 12 months really does require more than just a recovery in exports and more than just a recovery that's led by inventory rebuilding in industrial production. We need to see improvements in what we call final demand. Consumers and companies need to start buying again, need to start investing again for the recovery to be self-sustaining, as we would say. If I may, I'd now just like to share with you our BNY Mellon Asset Management's views for the outlook for economic activity for 2010. What's our working assumption, if you like, for the environment that we're likely to be in over the course of the next 12 months? Well, in developed markets, we think, yes, a recovery will continue. A recovery that we would say, relative to history, is subpar. Most, if not all, post-war recessions have been followed by a very significant recovery. And we believe this time is no exception. We will see an ongoing improvement in global economic activity, but the rate of improvement, the rate of change of that improvement, is probably going to be, in markets such as the US, the UK and Europe, somewhat weaker than you typically see during normal recovery phases after a severe recession. Inflation. We believe inflation continues not to be a problem. In fact, if anything, at the margin, deflationary risks are the things that will probably preoccupy policymakers for the coming 12 months. I know a lot's been said and a lot's been written about policy and the impact policy may ultimately have on inflation rates and the impact that higher inflation rates is going to have on the stability of the global economy. We believe, yes, that's a problem, but it's not going to be a problem that markets need to worry about in 2010. In fact, it's the opposite. It's ongoing deflation and therefore ongoing policy stimulus that will characterize 2010. And it also means for us that Asia continues to lead Western markets in terms of growth. And arguably that growth differential doesn't narrow but gets bigger as we move through into 2010 and into 2011. And the primary reason for that, we believe, is that the pace of jobs recovery in the US is going to be weaker than we've seen historically. The bottom chart on this slide shows you the recovery and employment from the peak of a cycle after a recession through into the recovery phase. There are, in the post-war environment, the three worst recessions in the US have been in 1953, 1973 and 1981. And each one of those recessions, employment growth has recovered something like 12 to 18 months after the peak in economic activity. About now. The peak in economic activity in the US occurred in the fourth quarter of 2007, and we're about 18 months beyond that point. So we should start to see labour market conditions in the US and therefore growth conditions in the US, and therefore growth conditions globally improve as the labour market improves. But we do believe there are some structural issues, not least to do with the deleveraging in the household sector as individuals try and repair their balance sheets by increasing their savings rates, will mean that unemployment recovery is sluggish relative to history. And it's that sluggish recovery in employment that means why we see a relatively sluggish subpar recovery in economic activity in Western Hemisphere markets. And why, as I said, we believe that that growth differential between the US and Europe gets bigger and not smaller relative to Asia over the course of the next 6 to 12 months. So, what does that mean for investing? What does that mean for the advice you can give your clients today about how to position themselves to take advantage of the environment that I've just described? Well, as I said, I think even though we see what we call that subpar recovery in activity in Western markets, we still think that fundamentals will continue to improve gradually. And for as long as that process happens, we think equity markets will continue to do well. We basically see the positive momentum that's been built in equity markets over the last 6 months continuing for the next 6 months. We don't believe valuations have yet got to the level that would ask you to question the recovery. We do not believe that the underlying fundamentals and valuations are out of sync. We do not believe that markets have got too far ahead of themselves, as we would say. Valuations look okay. They are not a reason to be bearish on the outlook for equities from here. If you're going to have a bias, I am a global investor. I build asset allocation portfolios for our investors globally. They ask me to take global views. When I take global views in equities, unsurprisingly, based on what I've said, I continue to favor emerging equities. I continue to favor Asian equities over developed Western markets, simply because the corporate fundamentals, the economic fundamentals look better and will get better relative to Western markets over the course of the next 6 to 12 months. In terms of a view on bonds, bond yields have risen quite significantly as the recovery has gained traction. We don't believe a bearish view on bonds over the next 6 to 12 months is warranted. We wouldn't be aggressive buyers of government bonds, reflecting